thank you to the audience for being patient for the first couple of minutes as we wait for people to join in. So I'm Sankalp, and I represent the business development team at PMS AIF World. And on behalf of PMS AIF World and ValueQuest, I extend everyone warm and hearty welcome. I hope you all are keeping safe and and at home and following all safety protocols. So today's topic is very, very interesting, and not just because we had some kind of volatility in the market today, but it is at the broader interest of investors and us as Indians to understand where we are in the economic cycle and what to expect and what to understand from here and the nuances of the Indian economic cycle. And the topic is aptly named, therefore, Indian economic cycle stronger for longer. So we'll understand with Ravi, who you can see on the screen over this call, what he thinks about the market, about businesses, about industries. But let me just give you a little bit of introduction to Ravi and ValueQuest. So Ravi is the founder and CIO at ValueQuest Investment Advisors. ValueQuest is now close to a decade, more than a decade old company, and the Dharamshi family, which Ravi represents, is close to 4 decades in the equity market now. ValueQuest manages close to 1,800 crores across 3 strategies. A couple of them have been doing quite well with an XIRR of over 23% in the last 10 years. PMS AIF World has also consistently said that one of their strategies is amongst the top performers in the 10 years plus vintage category. Ravi has an MBA in finance from McCallum Business School, which is part of the Bentley University. He worked he did a brief internship with the legendary Salomon Smith Barney at in the US, and has been in the Indian stock markets over the last 21 years. He also spent 4 good years at Rare Enterprises, which is also one of India's most desirable and enviable investment partnership. So Ravi, welcome to the webinar today, and we're all excited to hear from you.
Thank you, Sankalp, and good evening to you and the viewers.
Right. So Ravi, let me just tell you quickly the results of a poll that I run before I set the context, before I hand over the floor to you. So I asked markets from here to where, rally, correction, or sideways. Majority of the audience today, 47%, feels that it's going to be a sideways market for a while. There is 19% people who believe that the correction could be around, and 33% people believe that that this doesn't matter. It's a minor blip, and the markets are stronger than ever. So over to you, Ravi, and your interesting presentation, which we will listen for first half of the webinar and probably then take questions from the audience as we usually do. So over to you, Ravi.
Sure. Thank you so much. Good evening, everyone. I'm just going to show you a quick video so that that will give a little context to what I'm going to present. I hope
Ravi, I think the audio is missing.
Okay.
Can you tell us quickly on the chat if you can hear the audio?
Audio is on.
To the audience, can you please quickly tell us on chat if you can hear the audio or not? Ravi, I'll just ask you to paste the URL. I'll tell you. Sorry to the audience. Can you just go to the video tab on the right hand side? So majority of the audience cannot hear. So don't worry. We'll just get it on board.
No problem. I'll share the link of the videos with you, and not a problem at all. I'll straight away get into the presentation.
Right.
And so basically it was an introduction to what we are doing, and also it was so I've had a very strong view on the Indian markets and economy since the bottom of March 2020, and this presentation is in continuation of that. So that would have just provided a little bit of context, but no issues. We can get straight into it. And the title straight away gives it away, what I'm going to try and say: Indian economic cycle stronger for longer. As Sankalp very aptly put the context, and since the markets have been a little volatile for the past couple of months, so obviously we'll try and focus more on the economy rather than the markets. And one has to understand that economy and market might have a positive correlation, but they don't have an exact and absolute correlation. So there are times when economy moves ahead of the market, and there are times when market moves ahead of the economy. So right now it might be the case where markets might have moved half a step or a step ahead of economy, but where we gather our strength, or where we think one should not be too bothered by the volatility, is from the fact that Indian economy is likely to remain longer for stronger. So let's just get straight into it. So for all practical purposes, India has had only one notable boom period post-liberalization. That was in 2003-08. From 2003, the Indian economy enjoyed a boom in growth for 5 years. There was almost a 9% plus kind of a growth in GDP. And it was driven by private corporate investments and financed by rising domestic savings and topped by unprecedented inflows of foreign capital. So there was 22 quarters of continuous economic expansion, and the average real gross capital formation was around 15.4%. So we have not had, clearly that is the reference point that we have, because there is no other reference point where we could have had such a high growth period. So why am I comparing the current scenario with that period? We will come to that. So these were the prevalent conditions at that point of time in the June of 2003. So this particular boom period lasted for 22 quarters, as I mentioned earlier, and 15.4% was the average real GFCF growth. So what were the global and monetary liquidity conditions at that point of time? So US 10-year yield had dropped 220 bips. All the central banks combined had put in about $0.9 trillion worth of they had expanded their balance sheet by 0.9 trillion, which was roughly about 3% of the global GDP. US fiscal deficit had expanded from 2.4 to 3.7%. So the global monetary conditions were benign. The domestic monetary conditions were also benign. Repo rate was at 4.5%. Domestic liquidity was in a little bit of deficit. And the combined domestic fiscal deficit, which is states and center, was at 9.3%. So, and banking net NPA was at 4%, and tier 1 capital was at 8.2%. So basically, banking system had healed itself as compared to the previous few years, where the NPAs were high and tier capital was on the lower side. Corporate leverage had come down to 1.3. Tax rate was at 36% at that point of time, and government push was visible on the privatization and the infrastructure side. So now, when this kind of push was given to the economy at that point of time, what kind of a boom did it result in from the capital markets point of view? So the listed corporates X of financial in the 5-year period saw a sales growth of 25% compounded over 6-year period, and the profit of these companies saw a 37% compounded growth over a 6-year period. This led to an ROE expansion from 10-11% to 22% over the 6-year period, and market cap increased at a CAGR of 53%. Essentially, from below 5 lakh crores, the market cap went to almost 40 lakh crores. So that was an 8x jump in a 6-year period. Even at index level, you can see a 7x kind of a jump, because Sensex bottomed at around 2,900 and it went all the way till 21,000. So, and the best performing sectors, there were more than 20 sectors where the returns were even better than the average of the market. So that tells you that it was a very broad-based and across-the-board boom in Indian markets. Which were the themes that really panned out at that point of time? So globally, China rose to the top of the commodity chain. And of course, there was a globalization that was happening, which is where India also plugged in to some extent. And there was a telecom revolution happening. while in India became back office to the world, where outsourcing picked up, IT services picked up in a big way. India became pharmacy to the world. Indian corporates started having global aspirations. India started building infrastructure across the country, and the Indian consumer finally started showing up its presence, making its presence felt. So those were the things that panned out in that particular boom. And this was a very, very virtuous cycle that was panning out because of the investments that government was making. The productivity was increasing, the economic growth was higher, which led to an increased tax revenue base, and which led to an private capital increasing, savings increasing, and capital flows flowing into the markets. So this is the virtuous cycle that we believe has just begun in the current market, and that is why it is likely to continue for a period of time. But let's get further deeper into it. So now let's take a look at what the situation is at this point of time across various cycles. So deleveraging. So Indian corporates have deleveraged from roughly about debt to equity of close to 1. It has fallen to almost 0.6 debt to equity, net debt to equity. So that tells you that corporate balance sheet is probably the most delevered in the last couple of decades. NPA cycles seem to have peaked in the year 17-18, and it has started coming down. So that is an added tailwind, that growth is also coming back, and the asset cycle quality has also turned for the better. So RBI repo rates have fallen. They have fallen to almost 3.354. Now there is obviously a view that interest rates are going to rise from here, but we'll come to that in a moment. But what the point I am trying to make over here is that the repo rate was far lower than the Jan 2003 period, from where the previous boom had begun. So are rising interest rate a threat to the economic cycle? As you can see from the chart, from period Jan 2003 to 2008-9, actually the interest rate kept rising. From the GSEC yield rose from about just above 5% to all the way till 9% in January of 2008. So through the rising interest rate scenario, the markets continued to boom. So right now there is a lot of fear regarding the US 10-year yields rising. No doubt about it, it can lead to volatility, but it cannot puncture the uptrend that has begun, in my opinion. So Capex cycle is another thing. This is a global corporate Capex cycle which is going very strong, which will be one of the big indicator or input to the cycle that will go on in India also. Capacity utilization in India are at a bottom, even lower than the FY 2003. Surely, COVID has decreased the capacity utilization. It has made it unpredictable, and to plan how much inventory one should keep, how much production one should do, and whether to take orders or no. So that uncertainty is playing a lot into this capacity utilization. But the worst seems to be over, and things seem to be looking up. So low utilization levels are, as I mentioned, the levels are lower than the FY 2003 levels also, fixed asset turnover. Center and states have started accelerating the capex. The chart on the left shows you that center is accelerating the capex. Now, this is the data for the first half of FY22, and there is a clear pickup from about 2 lakh crores to about 2.5 lakh crore. So the government is front loading the capex, and the state capex have also risen, as you can see from the chart on the right. Also, a news item yesterday would have told you that center has given almost 2x of the devolution of the taxes to the states to help them continue with their capex program. This is an important indicator. To the left, that circle that is there is the CFO to capex, essentially the cash flow from operations to the capex. That tells you that which was at a peak of around about 2.5 in 2003, we have reached those kind of levels again, as in the companies are generating a lot of cash and they are not yet deploying that kind of money into the capex. So this thing is not sustainable for sure. We are going to see an increase in capex, and yes, the capex is usually a lag indicator of the uptick in economy, because first the utilization levels need to go up, companies need to make profit, generate cash, and then it leads to capex cycle. So it might be 4 quarters away, the overall capex cycle, but there is no denying that the capex cycle is coming. This is again a very busy slide, but essentially the point that we are making is that there are multiple drivers that are falling in place for the investment cycle to pick up. Real estate is picking up, global outlook is picking up, private and public sector, both capex are picking up, utilization levels are rising, leverage is on the lower side. So everything points to the fact that there will be a pickup in the investment cycle. And this is visible through the capex announcement that is being done by most of the corporates. These are various sectors, and we can see that there is a substantial jump in the announcement of the capex. Few sectors like renewable power and metals and oil and gas are the ones leading at this point of time. Let's take a look at the manufacturing cycle. So there has been a 2 trillion rupees PLI scheme announced by government across 13 sectors, and I'm sure the government has the now template to replicate this across more sectors if needed. So the 2 sectors that have already shown signs of success are mobile manufacturing and electronics component, particularly AC, room AC in that. So this is the first time. This is a big change in stance by the government. No longer are Indian policies and regulations encouraging companies to stay small. They are actually incentivizing you to gain scale and achieve competitiveness globally. So this obviously is going to kickstart the capex as well as the manufacturing cycle. And then there is China Plus One, which is leading to some amount of shift in the global supply chain towards India. This shift has been visible across the world. For wave 1 was when it shifted from US to Japan after World War II. Wave 2 was when it shifted from Japan to Europe, and from Europe it shifted to China and Southeast Asia in the last decade of the previous millennium and first decade. And now it looks like it is moving from China to India. Some lead indicators which point to the fact that manufacturing cycle is picking up is that the number of new companies registered has seen a pickup. And within that, the breakup is, you can see the number of manufacturing companies that are getting registered is the one that is that indicator is at the highest. Environmental clearances are not yet showing a pickup, but based on the fact that so many PLI schemes are getting announced and so many new companies are getting registered, there is no doubt that this chart will also start going up. So there is a large growth contributed from manufactured goods. So exports are picking up for India, and within that, manufactured goods is having a larger and larger pie. India's share of global exports is rising again, and this export, of course, as I mentioned earlier, is being driven by the manufacturing goods. Now coming to the housing cycle, real estate. Again, the same thing we have already seen. If you have been following for last 12-18 months, the real estate cycle has bottomed and has picked up in a very, very strong way. Just 2-3 points over here: all-time low interest rates, all-time best affordability, inventory being on the lower side, and supply crunch in terms of number of developers reducing. All these things are contributing to the fact that there is a real estate uptick, and that is going to last. It is not driven so much by the prices, but it is driven more by volumes. Yeah, so home loan, this is the cheapest the home loans have ever been in the history of India. That is below 7%. That just tells you that it is so affordable right now to take a EMI based home. Affordability, again, not only the difference between the wages and the housing is at the low, availability of loans is at a high, and the cost is also low. Everything, if you are a consumer of real estate, this is the best time to go out and buy. Already we are seeing a pickup. Top 7 cities in India make up more than 90% of the real estate market, and the trailing 12 months are showing a pickup already. And by FY23, we are likely to cross the previous high in terms of volumes that we had made. Yeah, another chart showing residential sales are picking up and inventory is dropping. So this is the inventory trend across the 7 key cities, and you can see that Gurgaon, it has already fallen much lower. So coming to the profit cycle, finally, Indian markets are driven by the profits. And in fact, for that matter, any company stock price is driven by the profit and the growth it is showing. And you can see in the first decade of this millennium, the corporate profits were rising. The 3 to 8, there was a huge boom. And then for the second decade, there was a continuous slump. But there has been a pickup from FY20. Not only there has been a pickup, but the number for FY21 is higher than it has been probably since FY14. So it's not just a adjustment for the normalization of what the COVID impact would have been. So there is a big pickup on the margins. A lot of contribution, of course, from the fact that the tax rates are lower, but there is a margin improvement as well. So margin improvement and tax are the 2 big contribution, but the growth is also coming back for a lot of sectors. So we have turned from vicious cycle to virtuous cycle. The red dots indicate where we were in the Q1 of FY20, and green dots indicate where in the cycle have those indicators moved in Q4 of FY21. And corporate deleveraging is nearing its end. Corporate capex is at the bottom. It's going to improve. Corporate profitability has just picked up. Housing is ahead of the corporate profitability, and asset quality is already on the improvement, while interest rates seem to have bottomed. So why do we believe that growth cycle this time around is going to be stronger for longer? So if you remember the first slide that I showed about how conducive the environment was in 2003 when that boom started, let's juxtapose it with how it looks at this point of time. So before we get into that, the Indian government has been preparing a glide path for a longer and stronger path. How? So we have been physically connected. There has been far more spend that has been done on the infrastructure. Finally, we have a taxation regime which is uniform across the country, and we are all digitally and financially connected to the banking system. The NPA cycle has been in the cleanup phase for a long period of time. We have put in place a mechanism for NPA resolution, which is the IBC, Indian Bankruptcy Code, and we are trying to build a safety net. So we are trying to have a constant, sustained, and inclusive growth. So let's see if what we have done in each of those 3 to make it last longer and stronger. So, of course, we need to have institutions, first of all, in place, which are globally benchmarked to, these are the softer things that need to go along with the economic growth to make sure that the growth lasts longer. We need a public sector that is more efficient. We need transparency. We need to have property rights for women. We need more participation from women in the economy. We need high corporate governance. And we need a government that is oriented towards future. So we have been physically connecting with, India has estimated that India would need to spend about 4.5 trillion on infra by 2030. So we already have spent a lot. We have a lot of ongoing projects like Bharatmala, Sagarmala, Delhi-Mumbai Industrial Corridor, Dedicated Freight Corridor, and Smart Cities. All this is going to make sure that we have better infrastructure, efficient infrastructure, and we are connected as a nation geographically. Then, of course, just the geographic connectivity is not enough. We need to be connected through the taxation regime as well. GST was one of the biggest reform. No doubt it had a lot of inconvenience, and probably the inconveniences still persist, but that does not take away from the fact that this was much required. One nation, one market, one tax was very much required to for any company who wants to come and invest in India to look at India as one market instead of 30 different markets. So with one stroke, India has converted India into a unified market of 130 crore citizens. Now, one, we are geographically connected. Second, we are taxation-wise connected. And now we have taxation which is globally competitive. So we have corporate tax rate where the base rate is at 22% as against the 36% that we saw earlier. And for the new Capex, the tax rate is at 15%. So clearly, we are trying to welcome the foreign corporates to come and settle, put money over here. Even the private companies over here are encouraged to put new Capex because that will put them in a lower taxation regime. We are connected digitally and financially also, and there's a big startup revolution that is going on. So what is India Stack? So India Stack is, in my opinion, single-handedly responsible for getting all of us connected to, and it is essentially a public utility good. So there are 4 layers to India Stack. One is the consent layer, second cashless layer, third paperless layer, and fourth presenceless layer. Essentially, if you have opened a bank account today, you would know what the India Stack is. It has taken away the need. You just need your fingerprint and you need Aadhaar card, and you can be in a remote area and you can open a bank account without meeting anybody in physical presence. And the bank account is open, which you probably used to take 15 days, is now less than 2 days, if not 1 day. So that is the power of the India Stack. This is the evolution. It is based on Jan Dhan, Aadhaar and mobile Jam Trinity, which is first more than 35-40 crore accounts got opened. Everybody got more than 100 crore people got onto the Aadhaar. And then third, of course, we were connected through mobile. And so now the seamless pipe is available not only for government to give DBT and benefits, but also for us to do all kinds of transaction amongst ourselves. So this is just an example of if somebody needs a loan, they agree to share data, see the loan offers, accept the best offer, receive loan, and sells goods and repays loan. Everything, all of this activity can be done digitally without needing any kind of a physical intervention. So India, this is a statement by Nandan Nilekani, India will become data rich before it becomes rich. And we are already seeing that through social, commerce, payment, paperless, and digital identity. We have already started sharing so much of data. And this data is secured and in a public utility where nobody can breach. So now people are connected and they have shared their data. So it's easier for corporates to go and verify, do KYC, and cross-check and verify everything, all the data without needing any kind of in-person verification. This is leading to a digital revolution in India. India is the second largest internet base in the world. We have probably the largest base of, after China, the number of online shoppers, one of the largest smartphone base, and we are witnessing huge number of transactions that are happening digitally. So obviously this has been enabled by the fact that we have the India Stack, which led to the this kind of a boom in the e-commerce. That was one more reason why our glide path is on the higher side. So I'll just summarize why the economy is going to remain stronger for longer. The conditions prevalent are more conducive. US is undergoing a massive technology boom. There is a massive stimulus that has been provided globally. There is a confluence of cycles in India. Indian corporates have never had it so good. And there are certain X factors which can actually give India an added kicker. So let's go through each of this thing. So today's conditions are far more conducive than what were there in 2003. If you remember the slide first I made. So even today, US 10-year yield has had a 175 bips drop. Of course, now I'm talking something that was 6 quarters old. So now there is a rise also from that point of time. But the overall global and monetary and liquidity conditions are still loose to the date. We barely have crossed the pre-COVID highs in terms of We have not even reached 2%. So prior to COVID strike, the rates used to be 1.8%, and we have just about crossed that level now. The amount of liquidity injection that was given in the last 6 quarters is more than 10 trillion, which is about 12% of the global GDP. Now just compare it with what was given, 3% of the global GDP in 2003. That 3% of the global GDP compares with the 12% of global GDP. So huge amount of stimulus that has been given. The fiscal deficit has increased from 3.6 to 15.4%. That is the kind of balance sheet expansion that US has done. Now coming to the domestic situation, we also have Indian repo rate at 4%, which is a 250 bips drop. We have a 4.5, in fact more than 4.5, more like 6-7 lakh crore kind of surplus that is sloshing around in the banking system even till date, which is better than what was in 2003 when there was a deficit over there. And we have a fiscal deficit, which essentially means that we have expanded our balance sheet by 12.5%. But despite all that, the banking system is in a far stronger state than it was in 2003. The NPAs are lower and tier 1 capital is higher. Corporate leverage is also on the lower side, and corporate tax is on the lower side. And the government push for reform is very, very strong. It is even stronger than it was in 2003. We have GST, IBC, corporate tax, agri-labor reforms, and many, many other things which the government is pushing. So this tells you that the environment is far more conducive than it was in 2003 when we had a 5-6 year kind of a continuous boom. Now, this chart just shows you what kind of impact that had on the capital markets. So in 2001, when the September 11 happened, the world economy was at world market cap was at 22.7 trillion. In 6 years' time, we almost tripled to 63 trillion based on the liquidity injection that were given in 2001. Then in 2009, post the global financial crisis, when the global market cap was 32 trillion, we gave another $2.5 trillion kind of a stimulus, and that led to again tripling of the market cap over the next 11 years, from 32 trillion to 90 trillion. Then it happened. Then the COVID came about, and that led to a sharp 40% kind of a decline in the world market cap to $65 trillion. But then the mother of all stimulus was unveiled across the world, which has doubled the market cap till date in last 20 months. Does this mean that the story is over? Looking at the kind of market cap increase that had happened the previous 2 times, looks like we have barely begun. So I won't be surprised if in another 5 years' time, the global market cap ends up being closer to 200 or 250 trillion dollars rather than where we are today. So there is a confluence of cycle, as I mentioned earlier. There is a deleveraging cycle, which is leading to NPA cycle reducing, which is leading to interest rate cycle being on the lower side. Manufacturing and housing cycle have just kicked off. Capex cycle is on the anvil, and profit cycle has begun. This is the confluence of various cycles, which is going to lead to a growth cycle, which is much stronger than it was in the past. Yeah, again, the same thing, summarizing the whole thing. Only point I would like to make over here is that Capex is the only cycle that is not yet visible. Every other cycle has already started showing signs, not only green shoots, but strong signs that the cycle has begun. Now, Indian corporates have never had it so good. What exactly do I mean? So not only is the government now providing a protection against international competition, we have basic customs duty, ADD, all kinds of duties are being put in place to ensure that we are protected from the unfair trade practices from other countries which are trying to dump goods into our country. There is incentivization for scale, essentially the production linked incentive scheme. There are policies in place which make it compulsory to procure from domestic certain percentage. So whether it is on the defense or whether it is in the solar, there is a strong policy and which is getting implemented that you have to procure locally. The cost of capital is on the lower side. The ease of doing business and the kind of encouragement that is being given to entrepreneurship is unparalleled in the history of India. So not to say that everything is hunky-dory and there are no problems in India. For sure, there are still a lot of problems, and especially we still have to get a few things right. Like we have to get our FTAs right, we have to get our judiciary right, the contracts, the sanctity of the contracts need to be maintained. Some of the things like retrospective taxation, everything which have been resolved now, but should have never happened in the first place. Government needs to get out of business. All those things are still desirable and are going to get achieved. But at this point of time, you can very safely say that we are in a much better position than we have ever been in the past of India. Now, and we add to that the fact that we have a population size connected market. The ability of a company to scale up across India in a very short period of time has grown up exponentially. So all these companies, for the old economy companies, the legacy companies who have been around for 20, 30, 50 years, there are so many companies that are still somewhere in the 500 to 5,000 crore kind of a turnover range. But the kind of scale that is being achieved by these new age company is already a multiple of that. There are so many companies that have achieved $1 billion plus revenues. That itself is a testament to the fact that something is working right. So Indian corporates have never had it so good. They will continue, they will invest, and they'll make money. And there are a 2-3 X factors which are going to add to the fact that India is going to do well. So there is a startup revolution happening. There is a energy transition happening. This is an overarching theme that cuts across many, many sectors. And there is China plus one, which is feeding into the fact that the global supply chain wants India as a partner. So these are 3 mega trends, and India has a leading role to play in this. In each of these, in the energy transition, we have initiated the International Solar Alliance. We have a target to do 450 gigawatt by 2030. We have National Hydrogen Mission, which is very ambitious. We are only 9% of the emerging markets power consumption, energy consumption, but we are going to be 20% of the incremental energy demand over the next decade. So that tells you the kind of clout India is going to have. And we will have more than 63% of the installed capacity from non-fossil fuel based sources in 2030. So there is a huge push towards renewables, and this transition is happening, and India is playing a leading role over here. Startup ecosystem. Now, in 2003, there was no startup ecosystem. Today, we have a startup ecosystem which is 1/10 of the listed space. Listed space is about 3.3, 3.4 trillion, and the startup ecosystem is already close to $350 billion. And it is going to be $1 trillion value in next 4-5 years time. And this startup ecosystem is what is going to aid India in becoming a $10 trillion economy in the next 5, 6, 7 years. And then last but not the least, the other mega trend is the China plus one. There are some push factors which are driving people away from China, whether it is the rising wage cost, reducing working age population, anti-pollution norms, sunset clauses in government incentives, trade war with US, COVID, and in general, over-dependence on China for everything. This is what is driving the world away from China and looking for a partner. Now, what is it that India is doing to make sure that they grab that? There is a stable government, and government policies are stable. There is a push towards ease of doing business. There is a big domestic market that is being showcased. Sector-specific production-linked incentive schemes have been announced, and taxation incentive is being given by putting the corporate tax down to 25%, and for incremental capex, it is down to 15%. So, with that brief, I just would like to say it is India's turn to take the center stage in the global arena, and this economic cycle is likely to remain stronger for longer. No doubt that it is not going to be an all one-way ride only up. So we will have our ups and downs as we are going through one such volatile phase in the markets, not in the economy, so to say. Thank you so much.
Right. Thank you so much for sharing that presentation. It was very, very insightful. So we can the audience, please keep sharing your sharing your questions in the chat box. In the meanwhile, what we'll do is we'll play the video for you. which we tried to play in the earlier half of the segment, and then we can move on to Q&A. So I'm just playing it. You can tell me if you guys can hear the audio.
He may be the new kid on the block. At an early age, he's identified the art of picking up multi-bagger stocks. And for him, performance really speaks.
Ravi has learned from majority of it comes from Mr. Junjunwala. He is one person who I'm really happy that he works with me. I think the inputs and the results have been very good. I would like to credit more to him than to my office.
Sorry, I was on mute. So that was the video, and thank you to the audience for being patient. So we've got a few questions that have come in from a lot of viewers today, and we'll take them. Before that, before we move ahead, one of the questions that I had was what we had seen during the best phase of 2003 to 8, which was obviously led by infrastructure, real estate, and a lot of other capital expenditure, real capacity creation, greenfield projects coming in. But what we saw during that time was a lot of the stories, proxies played out. When I say that, what I mean is, let's say for the housing boom, a lot of NBFCs did well, a lot of housing finance companies did well. When the corporate growth phase was happening, a lot of corporate banks did well. Okay, similarly, during the telecom expansion stage, a lot of telecom consultancy companies did well, or, manufacturers of chips or manufacturer of other components did well financially as well as business-wise. So do you think that might play out this time around? And the broader question is, what does all of this mean for the investor? The things that you discussed, maybe energy reliance and a shift in energy source, or creation of new capex. What does it mean for investors, and what are the sectors that you are looking at? On the call today, most of the audience feel that manufacturing, 39% of the audience feels manufacturing is the next sector likely to do well, and infra is the close second with 26%. So over to you, Ravi.
Yeah, so you very rightly pointed out, usually when there is a boom, it is the shovel sellers that do very well. So just to give you an anecdote where this saying comes from, shovel sellers, in the early 19th century, when there was a gold rush happening in California, there was people had found that there was gold lying in the rivers very close to California. People went rushed over there to dig for gold. But the real money and the stable money and the sustainable money was made by people, those who were selling shovels. Surely 1-2 people became rich finding gold, but if you were selling shovels or giving food to people, you are sure to make money. So identify trends that are going to last long, and then identify who are the ones, if even in the larger trend, if you can find a small company where the industry structure is such that they are going to take away a big pie of their portion, then that is a desirable thing as against somebody who is trying to go after the pot of gold at the end of the rainbow. So I am also a big proponent and a big fan of trying to play all these themes through ancillaries, through incidental beneficiaries, rather than, just to give you an example, there is going to be a solar boom for sure. There is going to be 450 gigawatt of solar installation happening over the next 10 years. Now, that does not mean you have to go and invest in the solar power generating companies. There are people, those who are going to make modules, cells. There are people who are going to get into consultancy, like you mentioned, for telecom, and they are going to make sure money because they have protection. And if, of course, again, this is not a recommendation to go ahead and buy, but what I would look for is the ideal conditions where they have protection and they have the encouragement from the government to go ahead and build scale. If that is the case, then you have a window at least where you are going to make a supernormal profit. Whether those profits sustain over a longer period of time, again, will depend on your ability to scale up, your ability to change the technology when it happens, ride the waves of technology change, and that will lead to sustainable value creation. So yeah, there are many ways to skin the cat, and my favorite one is to buy the shovel sellers rather than buy the gold diggers. Sorry, I forget what was the second part of your question.
The sectors that you broadly feel can benefit, like from what we discussed, and just a more broader understanding.
No, so again, see, there are three large themes. One is the X factors that I mentioned. One is the digitization and the startup boom that is happening in India. Second is the energy transition that is going to happen. It's a huge theme and it's a global theme. And the third is China plus one. Each of these themes, you can represent those themes in your portfolio in many different ways. You don't have to go and buy a startup to play the startup boom. You can actually figure out which company is trying to benefit from this startup boom in a way where for sure that startups are going to boom. There will be 1 lakh startups, but not all of those 1 lakh startups are going to become $1 billion plus company, or not all of them are going to become unicorns. If we have 1 lakh startups, we'll have 150 unicorns. So either you devote your energies to understanding and finding those 150 unicorns, or the companies that are going to scale up and become large, or you figure out the companies that are going to sell to these companies or can be a beneficiary from this particular trend. Now, there are also some of the incumbents who are actually going to adapt to this change that is happening. So just to give you a fact, just to give you a sense of what I'm trying to say, is that one of the old age NBFC yesterday itself announced an acquisition into this new age space. And they have made 2-3 acquisitions, and they have a stated intention of becoming a new age technology. The largest NBFC in this country is far more technologically savvy than some of the tech startups also. So that tells you that it's not necessary that you go out looking only for the startups who are going to create value. But understand that the theme is there is going to be a boom in technology-based business models, technology-enabled business models, and businesses that are pure tech-driven. So yeah, there are many ways to build the cat.
Right. Thank you. That was a very detailed answer. So we've got questions from Madhu and Santosh about trying to figure out what are the risks that could be there. Okay. We will not discuss about risks like COVID because they're unexpected, or a GFC, they're unexpected, and nobody can preempt them in that sense. But what do you feel could be more fiscal or policy level risks that could come to play here? Because you mentioned quite a lot of them, and we're talking about the broader economy. So over to you.
Yeah, no. So the real risk is always the one that you and I cannot anticipate. If I can put it down on a slide in my presentation, then that is a risk that market is most likely to ignore. Having said that, that doesn't mean that inflation that is cropping up now, or the move that is happening away, from the easy liquidity conditions, that is going to lead to some turbulence for sure. So I think that risks are more going to be specific to the companies that you pick up. So all this boom that is happening is dependent on a lot on these easy liquidity conditions. Now these startups raise next round of funding, and they keep moving up. If the tap was to stop someday, and if your business model has not crossed the chasm of reaching the inflection point, then it's likelihood that you will fall into that pit, and that will basically mean there is a zero. So there is a reality check for sure sometime in future for the offering for all the business models. the business models that have built that moat around themselves in terms of consumers being completely engaged and hooked on, and it is a profitable model, at least at the unit economics level. Even if not at the actual profit level, at the unit economics level, if you are profitable and you are not in need of any more funds to grow, then you are going to be safe. So the biggest risk I feel is that of course, this liquidity tap drying up someday. I don't think that is in the offing for the next 1-2 years, but that is a biggest risk that remains. The other smaller risk that I mentioned earlier through my PPT is that India still has, India always disappoints its optimists as well as pessimists. So being too optimist on the cycle being up, there are things that can go wrong. One, for sure, there is central elections 2 years down the line, and things can change dramatically over there. The stability that we have today might not be there. Two, the biggest bottleneck to the entire corporate world today is the judiciary. The costs in terms of duration, the efficiency that needs to be brought about in the judicial system, it leaves a lot to be desired. So if an incident like what happened with Vodafone or what happened with Kane Energy or some retrospective taxation or something of that sort were to happen, the judiciary actually transgressed a lot in the last decade and came into the executive decisions, which led to slowdown in a lot of industry. Those kind of things can impact and can lead to sector-specific slowdown, if not economy-specific slowdown, if not the entire economy. So I think those are some of the risks. They have happened in the past. I don't see any of those on the horizon at this juncture, but there is always a possibility that can happen.
Right. So very fair answer and I think very smart answer over there. So we've got a question from Mr. Ananda Archak, who is one of our regular listeners. He asks, with central government central elections coming in India in 2024, do you think a coalition government could change things, or the market might not be as acceptable of a coalition government? What are your views? We'll not spend too much time here because broadly we are not a political forum, but any views you can share over here?
What I can say is that it is very difficult to call an election. It is very difficult to call what the new government will do. And it is even more difficult to call how market will react to whatever that new government is going to do. So this lies in the realms of so many different things can happen that no point trying to position yourself for it or trying to waste airwaves over it. What one can take from the history that we have seen is that in India, despite whichever government, the direction does not change. Whether it was UPA 1, UPA 2, they are all from economic point of view, they are whether it is UPA or NDA, they are all cut off from the same mold. It is all dependent on the stage of the economic growth that we are in, and more or less the policies are likely to be in sync. So I am not going to fret and waste too much time on understanding that. It can lead to short-term volatility, and because it is impossible to predict, so many uncertainties are there, it's a waste of time, honestly, to think about those things.
Right. Thank you. So the next question I'm going to ask you is about your portfolio. What is it that ValueQuest does differently? Maybe you can share some snippets of your performance or some understanding about, how your portfolio fared during the COVID drawdown, just to make some, just for investors to understand what to expect at ValueQuest. And from Ravi.
Sure. Thanks for that question, Sankalp. The video that you showed for the introduction did have some amount of presentation, but we have given more than 120% kind of returns from the bottom of March 20. We are closer to 200% kind of return from the bottom of March 2020. But what I would request is we have a YouTube channel called ValueQuest. Do a search for it. On that, we have some videos where there is more material available about ValueQuest as well as the performance. Please visit our website also, and you will be able to get the latest information from there. But we changed our worldview dramatically in March 2020. We were positioned for a cyclical recovery in March 2020. We moved our portfolio more towards secular growth that was coming through digitization, through China plus one, and those kind of story, rather than from domestic cyclicals picking up. Today, now 22 months down the line, we are again shifting back towards companies which are more dependent on domestic cyclical recovery. So that is broadly how our portfolio is changing. Doesn't mean we are completely exiting away from the secular stories, and doesn't mean we are going completely into the, but this is the incremental change that we are doing in the portfolio.
Right. And, so the question that I wanted to understand from you is today, how does that differentiate ValueQuest as a manager from, let's say all the other managers that typically are there in the PMS business?
So we follow a multi-cap strategy, which is most of them. I don't believe that segmenting market on the basis of market capitalization is the right thing. There is, in a small pond also, a small fish can give fantastic return. In a large pond also, a large fish can give fantastic return. So we are a multi-cap oriented strategy. We will try and take advantage of wherever we see it. Second, we have a very concentrated portfolio, much more concentration than what others in the market would be doing. At client portfolio level, we rarely go about 10 or 11 stocks. It will be somewhere between 5 and 10 stocks is what we buy. We follow a very proprietary research-based approach. We are empaneled with all the domestic brokers, but we have our own view. We do our own work, and we put our money where our mouth is. So if we believe, and we also do a combination of top-down and bottom-up approach. First, we develop a view that this particular theme, this particular sector is going to do well. Once we have that view, then we try and look for which is the company that is best positioned to take advantage of that particular theme or particular sector that we are talking about. So yeah, these are some of the things in which we are different from the other PMSs. And
right.
Also in the way we have done businesses till now, we have grown all organically through word of mouth, references, family, friends, and their contacts. So that's how we have grown till now.
Right. Thank you so much for that, Ravi. Before we conclude, we got a couple of questions more, and thank you for the patient audience. One question I want to ask, and is from a viewer only, Santosh. He talks about ESG, and that changes a lot of things. It's basically a very, very strong concept, and that's that is come ahead of a lot of other things as well as thematic investments. So what do you think about India's adaptation of ESG? A lot of ESG factors are essentially identities of good companies, but then it has its own unique nuances as well. So how do you think India adapts to ESG, and how do you think a lot of the ESG ETF money will come to India?
No, so absolutely pertinent question, and to the point. This is another large trend that is playing out globally, and it is going to impact the Indian markets as well. The companies that are, so what we have seen is that exchanges are also now providing a platform, called Prime, where companies that score high on the ESG criteria get listed on a separate exchange. Or so the perception is what creates the valuation multiple. And if you are able to create a perception which is you are above board, and not only perception but also reality, then your multiple can be far different to what the market is trading at. For us at ValueQuest, ESG has been an unsaid phenomena right from the beginning. It is only today that I can say that, this is what we were doing. We were doing ESG. But essentially, sustainability and governance has always been part of the framework that we follow. You want to bet on companies that are not likely to be only a cyclical winner. You want to bet on companies that can move from cycle to cycle and keep building on that sustainability. On the corporate governance front also, we would like to bet on companies that are above board. You don't want to associate it with with very rarely does a leopard change its spots in this market. People forget what happened 10 years, 20 years earlier. But basic human nature does not change. So rather not get associated with those kind of people or companies. Environmental factors is the only new thing that has been brought about into our consciousness, and it is important. So we are also adapting to that. In the meanwhile, in the short while, it might be possible that some of the companies which are actually not environmental friendly might benefit. So for example, chemical companies did brilliantly well over the last 7 years, despite the fact that it is one of the most highly polluting industry. It might so happen that because of all the resources moving away from the fossil fuel, there might be a shortage in fossil fuel. And by the time the renewable resources come on stream, there can be a period of crazy kind of a shortage situation arising. And those kind of things can give you returns in the short run. But I would not like to bet on something where I don't, I have question over the survivability of it 5-7 years down the line. Yeah, so that's how I would answer this question.
Right, and before we conclude today's session, since we are so close to the budget, a couple of comments on the budget, shockers or expectations from the budget.
No, I'm sorry to disappoint, but incrementally, the budget is only a bookkeeping exercise that the government does. Very few big announcements are made during government. Not only is budget's influence over the economy is reducing, one, the railway budget was moved out of this
union budget,
union budget. Then second, GST has made sure that the entire indirect taxation probably is outside the purview of budget. Third, the exercise is more towards the fringes, and it does not make a huge difference, and only the intent is known. And in India, it has always been, it is not the intent that matters, it is whether it is followed up with the implementation by the government that matters. So so budget remains an important exercise, but its impact on the market is reducing day by day, and I would not focus too much on it. I would just look at it broadly, whether it is continuing to support growth or whether it is taking a wrong direction in terms of taxation or any such thing. Those are the key things that I would watch for.
Right, and do you, if you had a wish list from the, since you're discussing economy, do you have a wish list from the government to include in this year's budget or in the upcoming budgets or upcoming policy calls?
Don't rock the boat. Continue the good work.
Right. Very fair. So thank you, Ravi. Thank you so much for being with us on the call today. Thank you to the patient audience.
Thank you, Sankalp, and thank you to PMS AIF World for giving me the opportunity. And thank you all for listening in. I hope I could add value to you guys.
Right. No, I'm sure you added a lot of insight and a lot of interesting discussions we had forward-looking, and that's always exciting in the markets. So I've dropped my book a call link for PMS AIF World. So if you guys want to know more about Ravi and ValueQuest, please book a call with us. Also, to people on watching this on YouTube, please like and subscribe us so that such content is promoted by the algorithm. Thank you, Ravi. We hope to see you again very soon. Thank you.
Thank you.